You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everyone. I know the screen says Thursday because I am recording this right now at 3:05 p.m. on Thursday for the sake of the charts that I'm going to be showing you today. But still, since we distribute this via email every Friday, I'm going to say Happy Friday. Today, we're going to be talking about sector rotation, stocks, bonds, revisiting the bond trade that I discussed a couple weeks ago and been kind of paying attention to, over the last 6 weeks, especially on the long-term end of bonds. But before we get into all that, as always, a few housekeeping items. If this is your first time listening or watching, and then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So please come back often. Feel free to subscribe. We're on iTunes and YouTube. For those of you who like to listen, you can head over to iTunes. For those of you who rather watch, you can do the YouTube thing. Whenever we have charts, of course, or any visual aids, they're always going to be on YouTube. And then typically we'll throw some charts on the web as well. If you're listening on iTunes and you want to kind of revisit this later, you can either go to the YouTube link and watch the video, or you can check out the images online. In addition, you can also follow me on Twitter at Adam Koós and Instagram at Financial Surgeon. And then last but not least, like I mentioned, all links, visuals, charts, educational resources are always available on our website. So let's go ahead and get started here. I'm just gonna kind of go. You know what? I forgot about my quote. That's right. I always start with my quote here. So today's quote, I'm going to talk probably next week or the week after. I think we have an interview next week on our podcast. Amber Gilsdorf actually is going to be on next week talking about college education, college savings, and really how to get the most bang for your buck for your kids so they can get the most scholarship dollars. So be sure to check that out next week. But maybe 2 weeks from now, I'll do a podcast a little bit more focused on sector rotation specifically. But today, I'm going to bounce around, talk a little bit about stocks, talk about what's leading, what's lagging, the sector rotation that's taking place right now, and like I said earlier, touch on the bond trade. And the quote here, which I suppose I should just use the same quote again in a couple weeks, is that sector rotation is the lifeblood of a bull market. In other words, you have to have participation from all areas of the market over time in order for a bull market to continue. So that was said by Ralph Acampora. I've had the pleasure of meeting Ralph several times. He's known as the Godfather of Technical Analysis, and he's truly a legend in our business. So I think that this quote definitely holds true, and it's very applicable today. So why don't we go ahead and look at some charts here. So for those of you listening on iTunes, I'll try to talk you through all this and keep it as simple as possible. And in advance, I'm going to apologize if I slip up at all because I just had to completely reinstall my Optima program, and all of my settings and shortcuts completely disappeared. So I'm working on getting all those things bumped back in. So let's see here. What are we talking about first? Let's talk about sector rotation first. So one of the things that I've shown in prior podcasts, prior screencasts, I should say as well, is something called a relative rotation graph. I was just talking to Julius DeCampanier yesterday and today, the guy who invented this beautiful piece of charting equipment. The upper left-hand quadrant is improving versus the market. The upper right is leading. The lower left is weakening versus the market, and the lower left is lagging or underperforming the market. And the market, in this case, is the S&P 500. So SPX is the symbol for the S&P. That's right smack dab in the middle at the 0 point on the XY axis here. So what we're looking at right now is the energy, which we own in our clients' portfolios right now, has been doing pretty well, but it's up in this leading quadrant. It's been outperforming the market, but just recently, this last 1, 2, 3 weeks or so, it's been lagging a little bit. Now, it's not lagging so much to the point where it would make sense to necessarily sell it, but it is lagging, call it on a short-term basis, and until this starts to weaken more, it's not something that would really concern me all that much. Something I am paying attention to, though, here is over on the left, you can see how consumer staples are the kind of stocks that are, the things we need. It's the old Warren Buffett says staples are things like, shaving. Everybody has to, buy a Gillette shaver, not necessarily Gillette, but everybody shaves everybody uses soap. So your staples are the things that you need. They're staples, you need them in our everyday lives. So that's one thing that I'm paying attention to that's doing pretty well here. And then healthcare is also it's kind of heading down here into that lagging quadrant. But if you look at a shorter term relative rotation graph, then let's make this 1 day. Then you can see how it's starting to curl up here. I'm going to back up a little bit, zoom out. So what we're seeing for the iTunes listeners is healthcare is kind of starting on a daily basis or a shorter term basis. We're starting to see healthcare find its way in that lagging quadrant, but what we want to be watching for, or what I'm watching for, is for this thing to kind of curl up and to see that improvement take place, to see the arrow on this RRG pointing upward and northeast into that, or toward that leading quadrant. But at least for now, right now, it seems a lot of the strength in the market is in the industrial sector, which has been doing pretty well. Communications had been doing pretty well, but just this past week is starting to weaken a little bit, but again, only on a short-term basis. And then financials. Financials are kind of sitting over here creeping sideways, but remaining in that leading quadrant. And like I mentioned earlier, the energy sector has really been outperforming the most on a long-term, we'll call it intermediate-term basis, but is just showing some weakness in the very, very short term, which, again, I'm not really all that concerned about. So that's the first thing that I think that I'm paying a lot of attention to right now is the sector rotation. When you have the market go up, it's typically going to be the big, huge companies on the index, like the S&P 500. It's a cap-weighted index, so when you have a cap-weighted index and you have big stocks going up, that's going to make the index go up. If you have small stocks not going up, or worse, going down, you're not going to see it as much on those large cap-weighted indices. Things like the Dow, for instance. The Dow doesn't even have any small-cap stocks at all. It's 30 big, huge stocks. So if the Dow's going up, you're looking at 30 stocks on a stock market of thousands of stocks. If you look at the Russell 3000, which is probably one of the best, call it proxies for judging the entire market. The Russell 3000 would include everything, but it's still, we still have to pay attention to the fact that when we're looking at the S&P 500 or the NASDAQ or the Dow, we're looking at, generally speaking, what the big companies are doing. We have to kind of look under the surface to see what's going on within this, call it this mid and smaller size companies, and then within the sectors. And again, to go back to the RRG, or relative rotation graph, that we were just talking about a second ago, there might be times when, those large cap, mega cap stocks, they call them the FANG stocks, the Apples, Googles, Facebook, and these companies, if they're going up, then they're going to push the market up. But you might own something like, for instance, energy in your portfolio, which, is a very, very good, and at least for now, on a relative basis, is a really good sector to be invested in. But in the short term, it might be showing that, why is the market going up and my portfolio is going down this last few weeks? And if you're overweight energy like we are, then that's what you would be seeing. But again, until we start to see energy really start to underperform, not just looking at an RRG, obviously we're looking at other things like the individual charts. In fact, let me see here. I'll pull up a chart real quick here. So let's go to XLE. So we'll look at the energy fund, and you can see if I zoom in a little bit here, this is a weekly chart. Blue is, I have this coded so that when it's in the leading quadrant, it's blue. So all these candlesticks are blue, telling me that in this case, energy stocks are in the leading quadrant, and that's where they are. Trend is up. We got a low back here in, March of 2020. So last March, just this October, November, we have a higher low, higher high in January of this year, as well as a higher low, and then another higher high just this past month. And now just this past few weeks, we've seen, like I said, a pullback. So nothing to be afraid of, but this sector still looks very, very good. As does let me go back to my sector workbook here, sorry. I'm looking at individual ETFs here, so I'll go back to that in a second, actually. So indices. So as does, like I mentioned earlier, the financial sector looks pretty good, kind of chopping sideways again in that leading quadrant. And then we're starting to kind of watch staples increase on a relative basis. And I will say one of the things to be concerned about, and not that I don't believe we're going to see a market crash anytime soon, by the way, but One of the things to be concerned about in the short term is that when we see staples start to improve and head into that improving quadrant versus the market, staples are a defensive asset class. So what that means is that, when defensive investments start to outperform, it typically means that we could be running into a point where the market might struggle. And as the S&P, NASDAQ have recently rebounded, hit all-time highs, now might not be a horrible time where we might see some weakness in the S&P 500, maybe a pullback. But any pullback right now, in my opinion, would be a buyable dip. I would not be looking at a pullback or a drop in the market in the short term as anything to be afraid of or something to be running away from or selling into. In fact, it wouldn't be a horrible idea that if you have cash on the sidelines to kind of look for that pullback as opposed to buying in right here if you're looking for a good short-term entry point. All right, now let's go back and look at those individual sectors just because I pulled that up a second ago. My tabs are all mixed up here. So how to get this thing working again. So I'm not going to be able to show you the animation, but that's okay. What I will show you is kind of a snapshot of what's going on right now. So this is going down into the sectors and into what's called industry groups. So we're not just looking at the broad sectors in the market in the U.S. We're also looking at the industry groups within those sectors. And what I'm seeing here is a continuation of in a prior podcast, or maybe it was our market quarterly scouting report screencast, I think it might have been, where I was mentioning that things like the ARK funds, so technology, lithium stocks, solar stocks, IPOs, biotech, cybersecurity. Here's more biotech here. So a lot of these tech names that were doing really, really well last year, online retail's here. It's kind of moving its way into the lagging quadrant here on this RRG. These are the things that aren't doing so well right now and really should be either avoided, or if you're going to be invested in something like this, you got to be really careful and make sure that you have a nice tight stop or an exit strategy underneath your buy point. So on the other hand, again, we have staples. So here we have staples pointing northeast into the improving quadrant. That's good. Here's equal weight consumer staples. And what that means, equal weight just means that it's equally weighting all the companies. So as opposed to the big companies getting all the weight, every company is weighted equally. So the small companies get their notice, I guess, if you will. Think of it like the Congress. In the U.S. Congress has a higher number of congressmen and congresswomen for each state, depending on how big the state is, whereas the Senate has 2 senators for each state. Well, when you think of cap-weighted market indices, that's like Congress, where you've got this big, huge weight, and then the equal-weighted indices would be like the Senate, equal weight. So just 2 per state, doesn't matter how big the state is. Something else I notice here that is really interesting, and again, for those of you listening on iTunes, is that gold miners, and gold has not been performing very well, really for months, but we're starting to see gold miners as well as small cap or junior gold miners here way outside in this lagging quadrant, but pointing north. Large cap miners in the improving quadrant pointing northeast, and so that might be something where we might want to look at that and say, okay, well, what's going on here with gold miners? And I'm going to pull up a chart of the GDX and zoom in a little bit here so you can see a couple things. Oh man, I wish I had my shortcuts. They're all gone. I'm sorry. So what we're seeing here is a downtrend going all the way back to the peak August 5th, and then from the peak August 5th all the way down to this low that we just saw in March, early March last month. Now that low here, you can see there's a bounce, and then we can see a higher low. And now we can see a higher high. So we could see gold miners bottoming right here. And another thing that I'll notice is that we're also seeing that RSI, or momentum, never got below 30, which is bullish. That's good. Ideally, we want it to stay above 40. That would be really bullish. That would be really good. But it didn't, and that's okay. But the bottom line is we're starting to see a bottoming process here. So GDXJ. So this is small cap miners. So small companies. Same kind of thing, just a little bit weaker. You can see, whereas the large cap miners had a higher low this past month in late March, gold miners, junior miners, small cap miners had a lower low. So a little bit weaker of an asset class. If I look at gold, so just pull up a chart of gold. So this is the GLD. One thing I'll notice, let me turn off my crosshair. One thing you might notice here is we've got kind of this low here in March, and then another low that's almost the same low just this past 2 weeks ago. It's almost the same low that we saw in early March, while in momentum here we're seeing a higher low in momentum, and that's what we call positive momentum divergence, and that's a good sign. Seasonality for gold also is kind of turning up here on a historic basis. So I'm not one to bottom fish. That's just not typically what I do, with some rare exceptions. And one of those rare exceptions might be what I'm looking at right here, which is this higher low in momentum, while gold is kind of flattening out, or call it the same low. Now would be a good time. Let me close this up. Now would be a good time, speaking of positive divergences, to talk about the bond trade. Where's my playpen? What I want to look at here is TLT. TLT is the 20-year Treasury bond ETF. So Treasury bonds. And I mentioned on a couple podcasts ago, as well as in our screencast, the quarterly scouting report market update screencast, that since last April, and really you could say last August, 20-year Treasury bonds have been down as much as 22%, somewhere in that range, which is horrible. I mean, again, as one of my clients said to us just last week, they said, I thought bonds were safe. And I think that's one of the things we always have to remember, is that bonds and interest rates are inversely related. And interest rates have been going down since the early 80s. And as interest rates have gone down and down and down, now, of course, it was choppy. There was bounces along the way. But generally speaking, as interest rates have gone down the entire time, not in a straight line, but they've gone down, then we've seen bonds do well. Bond prices go up. Now what we're starting to see is kind of this bottoming process in interest rates. And as that happens, we're going to see more choppiness in bonds. And long term, it's going to be more difficult, or I should make maybe the better way to say it is, it's not going to be as easy to make money in bonds as it used to be. And we're going to have to be a lot more creative this next 2 decades than we did the last 2 decades. So one of the things that I was mentioning in the podcast and in the screencast last time, as you can see here, TLT, or 20-year Treasuries, you have a low here, and you can just trace my mouse down to a lower low between late February and then mid to late March. That's a lower low there, very clear to see. But we have a higher low in momentum, and then a continued follow-through higher as momentum as prices continued up. Now, if I look at zeros, these are zero coupon bonds, 25-year. We're seeing the same thing, except it's a little bit more dramatic, because the longer the maturity of the bonds, the more the fluctuation in the price, depending on the movement in interest rates. So far, so good. This bond trade is working out really well. It was a very low risk to high potential reward trade, and so far it's working out well. And as long as we continue to see this moving up from here and printing higher lows and higher highs, then I don't see a reason why we need to run away from owning bonds in the short term anyhow. Okay, so this last chart I'm going to show you here is just the S&P 500. It's a little bit looking back all the way last year to the bottom after COVID hit. In fact, the economy was still locked down back here in May. And the bottom pane is something called MACD, or Moving Average Convergence Divergence. And what we're looking at, or what I'm paying attention here, is we're starting to see the distance between the signal line and the moving average compress. And that's what these lower highs are down here in this little histogram. And as that happens, and we'll see what happens today, the market's up today, but we're starting to see a lot of daylight. And when I say daylight, it's the distance between this 50-day moving average or 50-day trend and the high. So the more the daylight, the higher the probability of it pullback, or at least a chop sideways. So you get a lot of daylight here. You can see we get a pullback. Get a little bit of daylight here, we get a pullback. Here, it kind of tended to stay relatively high, and then eventually it just kind of pulled back. So as long as the market is respecting this 50-day moving average, this 50-day trend, and as long as it's staying positive, obviously in a positive trend, then I don't see any reason why anybody needs to worry too much right now about a market crash. And again, as I stated earlier, I would treat any sort of pullback or even correction as a buyable dip right now. As long as the Fed's on our side, as long as they're printing money out the wazoo, as long as we are seeing stimulus come out, infrastructure stimulus as well, which obviously would be good for builders, materials, industrials, and so on, commodities even. I think that the market's going to be fine, but we're going to go through our typical everyday gyrations that we see in the market, just part of how the market moves, how it breathes. And again, that goes back to what we started with today, which was the concept of sector rotation, and that, when the lifeblood of the market is sector rotation, and as the market breathes, you're going to see pullbacks in the stock market and the major market indices. We're going to see things like materials maybe do well, maybe cyclicals are doing well now. We might see them pull back later and something else take the lead, like technology, for instance. But at least for now, I think everything's okay. I'm not really too concerned about the market, aside from the fact that, again, I would fully expect a very healthy and normal short-term pullback in the market sometime in the next, I would think, week or two. If not, and if it doesn't pull back, maybe kind of a steady chop sideways, because the market can correct either by correcting in price, or it can correct sideways by digesting those gains and chopping sideways. All right, so that's going to be it for today. Feel free to share this episode with your friends and family, and if you'd like to discuss your personal situation further, please remember you never have to be a client to ask a question. If you'd like to set up an introduction call with myself, please feel free to head over to our website. You can schedule a call on our calendar right on our contact page, get access to our calendar there. And as I always say, there is thousands of podcasts out there, and you chose to give hours to listen today, so thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube, and remember, you can sign up at libertaswealth.com to get these updates, as well as our other screencasts, videos, articles, and other materials delivered directly to your email inbox as soon as they're released. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. I'm also, again, on Twitter at Adam Koos, Instagram at Financial Surgeon, and thank you once again so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.